Hey guys, it's Kat and Dean from Kernel here. Today we're running through part 2 of how to design a portfolio and the things you need to think through when you're considering asset allocation. So in our first webinar, we touched on the 4 starting points: your goals, your horizon, risk and diversification, and the core satellite theory. So if you haven't watched that already, click below and get started with that first, because today we are jumping into the nitty-gritty around how to choose funds for the equity portion of your portfolio, how to choose between them, and how to also consider defensive assets in the future, and a few different things to think through when you are going through various stages in life. But first, we're going to start with thinking around your equity portfolio and the funds that you have. We do have New Zealand and global equity funds, so we're going to start on that as I suppose, the first point, because it's always a hot topic and a great question. How much should I invest within the New Zealand market versus how much should I invest in global markets? So, Dean, over to you.
Thanks, Kate. So, yeah, there is no right answer here. There's no single answer, but there are a few things that you do want to consider. So often people talk about New Zealand is a little country at the bottom of the world, and our economy is less than 1% of the world equity market. So surely I should be investing offshore. Now, that may be the case, but there are actually some really great companies listed here in New Zealand. And actually, New Zealand has performed exceptionally well. So if you look over the past decade, we've actually outperformed the US and other major markets that you'll be very familiar with. And so the key here is actually understanding that there are differences between each of these markets. And so you want to have a bit of exposure to both of them. If you think about the US, you're going to instantly think and understand that there's a really large part of that market that is, dominated by the big tech companies. We don't have those in New Zealand. So we don't have the big Microsofts, the Teslas, and other companies that everybody talks about regularly. New Zealand has an economy and a market that's made up of a lot of more traditional companies, utilities, power companies, and those sort of things. So they act differently, and this is where the diversification comes in. So when you're building a portfolio, you want to ensure that your portfolio is diversified across a range of sectors and a range of countries. And so by having some exposure to New Zealand, you're going to have the benefit of those different sectors and parts of the market that you won't get if you just invested in the US or a total world fund. And so those are the things to think about. In terms of percentages, there is no right answer, but you do want to think about actually New Zealand is home, it has performed well, and there are some advantages to investing here, and that can't be ignored. And the big one there is tax. So as a New Zealand investor, there is actually a really big hurdle that your global investments have to overcome before they can be on parity with your local investments. So typically when you run the numbers on this, it's about 1%. So basically that means that your foreign investments have to earn at least 1% per annum more than New Zealand performance just to give you the same net results, so the same return in hand for you as the investor. And so therefore you do want to overweight New Zealand, and by that we mean you wouldn't have just 1% of your equity portfolio in New Zealand, you may have 10 or 20% or more. And so that's one thing to think about, is that tax. The other thing to think about with investing, not so much with Kernel, but other means, is that when you start to invest offshore, it can be expensive. Not only from a tax, but if you're paying lots of different brokerage fees or transaction costs. So all of those things come into play, and when you're thinking about how you want to invest and whether you're investing a lump sum or regularly. Obviously, if you're investing on a regular basis, then you don't want to be paying brokerage every single time to trade into these international stocks, but you can get that through a low-cost local fund that gives you that global exposure.
Yeah, absolutely. And I think it's probably worth mentioning that as a proportion, we have written a blog on this, which I'll link to in the notes. People in the US and Australia in particular have what's called a really high home bias. So individual investors in those countries have a very, very high proportion.
60-70%.
Yeah, exactly, to investing in companies listed within their own countries. New Zealand doesn't seem to have that as much, and I think it's probably because we are drilled into us a little bit about the fact that we're small. But the reality is, as we showed before, there has been some excellent performance historically within the New Zealand market, and we think it's a really great thing for Kiwis to obviously invest within their own country. So although we can't necessarily give you a rule of thumb percentage split, it probably, for us, we would say you can start at 50-50 and then adjust those percentages in either direction based on your goals, your preference, what you're interested in, that sort of thing. But definitely a lot more than, say, the 10% that perhaps people indicated in the past.
The other thing, and as an aside, taxes are a topic that maybe not everybody's interested in, but it can be important. And so we've done some work on that recently. So I'm sure Kat will share some links to some blogs that we've just been writing on tax. And we actually made a calculator. So to keep it really simple for you, there's a calculator that you can go and use through our website right now, and you can see the tax impacts of investing into international shares through different structures. And so that will help give you some guidance to think about how do you want to invest and what you should be putting into your portfolio.
Yeah, absolutely. So yes, I think that's probably the first starting point for this session, thinking through how much exposure do I want my long-term investments to have between the New Zealand market and global markets, and thinking through a little bit of a percentage split that you feel comfortable with there. Once you've decided on that, it's then, I think, the next stage is thinking through things like, am I 100% invested in equities, or am I also investing
sectors or fixed income?
Exactly, in other parts of the market. So we're going to talk through now something that we got quite a few questions on, particularly because I think if you read any financial literacy or literature from the last 10 years, it definitely talks about this type of portfolio. And then also it's something to think about, or retirees are told to think about, and that's investing in sort of a 60-40 split between defensive and growth assets. So Jane, if you want to just, I suppose, talk us through like what is 60-40 and why have we been told to invest like this in the past?
So over the last 40 years, if you had gone and seen any financial advisor or broker and any institution, they often have talked about the 60-40 portfolio. And basically that's 60% into equities and 40% into fixed income bonds. And those two things together have been the mainstay of portfolio construction for the past 40 odd years. And it's worked really, really well. Now, the reason—
And it's easy, right?
It's very easy. And so it's a simple thing to do. Now, the reason why you combine those two assets is that the correlation, and that's the performance between, if equities have gone up, fixed income may go down, but they counterbalance each other. That's helped lower the volatility of the total portfolio. So you've had less ups and downs. And so that's been a big part as to why people have both of those elements, because fixed income is a little bit more conservative, has less fluctuations, where equities has a bit more, and it helps balance that out. And over that 40-year period, it's performed exceptionally well. So by combining 60% equities with 40% into some bonds, the average investor over that period has had 87% of the total equity market return. So you've got most of the equity returns, but you've had nearly half of the ups and downs. So when your portfolio has fallen in value, it may have only gone down 10% when the market has gone down 20%, or the equity market has gone down 20%. So for investors, it's worked really, really well. But things have changed a bit. And obviously, if we think about where the interest rates are at the moment, it's really hard. And so bonds and other assets that are tied or connected to interest rates, they aren't going to perform in the same way they have for the last 40 years. And so what we're seeing is a lot of people going, well, can I, or really should I be putting 40% of my investments into fixed income or bonds? And so I think Kat's got a great chart that kind of shows what has actually happened to interest rates over this period. And so if you look, you can see there was a big rise in interest rates in the 60s and 70s, but for the last 40 years, some ups and downs, but the interest rates have been falling. And now, as you can see, they're very low. And in some parts of the world, actually, they're negative. And so as an investor, if you were in a term deposit or a bond, your return on your fixed income investments now is going to be quite low. And so having that allocation to fixed income, yes, it may help smooth some of the ups and downs in your equity part of the portfolio. But if you've still got a relatively long time horizon, if you're investing for 10 or 20 years, you may not need the same amount into those sorts of assets that you once traditionally did. And that's mainly because you won't get the benefits that they used to provide you. Fixed income actually has performed really well. So the fixed income part of the portfolio has probably delivered 7 to 8% anyway over that period. Now it's only going to provide you 1 or 2. So you're putting a large part of the portfolio into something that's not really going to give you the same diversification and the same returns that it used to. And so you need to think about other ways to invest, or be comfortable that if you've got a longer time horizon, you can have more exposure to equities.
Yeah, because I think as well it's worth touching on that there's a level of risk, right, in having right now in the current market conditions too much towards fixed income or defensive assets if it's not suited to your time horizon. So this really comes back to what we touched on in the first webinar and making sure that you have your now and your soon buckets for expenses covered through things like liquid cash and term deposits, and then really focusing on your later bucket and understanding and being comfortable with the fact that you might not need to use that for 10, 15, 20 years, and you probably have a little bit of flexibility around when you do need that money. So I suppose what would be your alternative, Dean, if we're thinking through, okay, traditionally perhaps an investor wanted, say, 40% allocation to defensive, understanding that due to interest rate environment and current market conditions, it's not really going to perform in the way that it used to. What are my other options?
Yeah, and so we're looking now at the equities, right? So we're looking at just the equity part of this portfolio. You've got a lot more options today than you ever have. And by that, I mean that there are funds that are more defensive. They own shares, but they are shares that are maybe more defensive or conservative. And so you can find these parts of the market or different funds that work together that give you some of the smoothing effect that fixed income used to do, but you're fully invested in equities. So a good example of that is things like our Global Infrastructure Fund. So infrastructure, global listed infrastructure, performs slightly different to just general broad equities. And very different to growth equities. And so it may not go up as quick, but they typically don't fall as much. So they're the same sort of attributes of what you would have got from a fixed income. Yes, you'll have more ups and downs than just being invested in a bond, but they're not going to react in the same way as just your wider equity. So by putting in some infrastructure instead of fixed income, you can smooth out the ups and downs. You can get a yield or income if you're after that, while still being exposed and making sure that your portfolio is going to grow over the longer term and you have the chance to benefit from the upside more.
Yeah, absolutely. And I think it's probably worth mentioning that, the creation of the 60-40 model portfolio happened however many years ago, when the reality was that there were mainly just core index funds in existence and probably not that many index funds in existence. Whereas now we're reaching a stage where there is so much available data that providers like S&P can create indices that really hone in on certain factors or themes or sectors that mean that you have a lot more flexibility in your overall portfolio allocation than perhaps you did 40 years ago. So I think probably one thing as well to touch on is the fact that investors are looking at things like dividend type funds or dividend strategies, and that those sorts of options can also be looked at as alternatives to the traditional fixed income portion. So do you kind of have some comments around that, Dean, in terms of, obviously indexing is just giving us a lot more flexibility now.
Exactly. So if you think back to the 60s, the first index fund really only started in the 70s. So 60s, 70s, all you really had as an option to invest was pretty vanilla equities in a standard company or a bond, but now there's a range of different investment options and strategies. So probably the key thing here is thinking about your goal and time horizon. If you are closer to retirement or you're looking for income, it is a different challenge for you than somebody who's 30 or 40 and does have 30, 40 years that they're investing for. If you're 30 or 40 right now and you're thinking about how you want to invest, reality is you probably don't need any fixed income, and you don't really need to introduce fixed income too early into that
your overall mix, really.
Your overall mix, because you've got a long time horizon. The returns in fixed income or interest-bearing parts of the market at the moment are really low, and you actually have some risk there if the interest rates rise. So think about where you are on your stage, how long you've got to go. If you are close to retirement or in retirement, the reality is it's really hard. The returns on term deposits now have actually gone negative in the real sense. By that, they mean if you take the return on a typical term deposit now and you deduct tax and you deduct inflation, your investment is actually going backwards. So in the last 12 months, if you've got money now sitting in term deposits, you're probably going backwards in the sense that the cost of things around you is going up faster than actually the return that you're generating on your investment. And so you do have to think about other options. And so people are looking at things like, okay, if you think about how you construct your portfolio and the now, soon, later that we talked about, you could go and take some of that and yes, still keep it in a term deposit for those next couple of years of cash needs that you need, that you may need, and then invest the rest and think about things like, okay, am I comfortable taking on a bit more risk? And I will put some into equities, but maybe more defensive equities. Maybe it isn't equities like infrastructure or other, more defensive type equity strategies that have good income, may not grow as fast as the wider market, but be a bit more stable. And so you can get that halfway point to try and meet your goals, particularly if you can ride out the time frame. If you're younger and you are saving, as a lot of our investors kind of talked about, no specific goal, you just want to grow your wealth over time, then look at the types of equity options that are available and build something that suits your specific goal. If you really want to go for growth, you can go for growth. If you're a little bit more conservative, you can still be all in equities, but you can introduce some funds that help smooth out the ups and downs. And so I think, when we're starting to think about that and we talk about building your portfolio and how you want to start investing, you can start with 1 or 2 funds. If this is your first investment, 1 or 2 funds, as we've touched on with other webinars, this core construct, you could go and start with an NZ20 and even a Global 100, and that's a good, broad global equity exposure, a range of sectors, a range of countries. It's a great place to start. If you then want to introduce something more interesting, things like the smaller mid-cap, that is a smaller part of the New Zealand equity markets, some more small companies that may be, the returns will be up and down a lot more, so a bit more volatility with that. Potentially, but it could be interesting if you want to take on the opportunity for greater growth over the longer term. Mm-hmm. So those are things that you can start to introduce over time if you're just new to investing or you're wanting to start building out your portfolio.
Yeah, I think that's a great point. One question that we did get when preparing for this webinar was how to think about cash in your portfolio and whether or not you consider cash as part of your overall asset allocation or it's something separate. And I think I wanted to touch on that because our kind of general view is we always talk about cash, as we did in our first webinar, as the now and the soon bucket. And that's something that sits very distinctly outside of your later bucket, which is what we're talking about now when it comes to equity portfolios and longer term investing. So the challenge that you can probably see with that is if you set aside a traditional kind of cash percentage allocation, if you have a starting investment of $5,000 and you're putting 5% of that portfolio towards cash, that's probably not enough for your emergency fund. So the traditional kind of percentage allocation doesn't really work in that instance. Similarly, it applies at the other end. If you've got $5 million, you may have a little bit too much cash in that portfolio there. So what we would sort of, encourage you to do is think about cash and term deposits as your now and soon. That's entirely distinct to your equity later bucket. And then when you're thinking through that later bucket, it's really around, how much diversification do I want? Are there different sectors and parts of the market that I want exposure to, potentially different themes? So I think, Dan, question for you is, it's easy to see all the different index funds available. Let's be honest, there's hundreds of them. They often have sometimes exciting names, particular different, descriptions, different companies. How would you suggest we think through as an investor, deciding whether or not we want to go down the path of investing in different themes or different tilts like value or growth or whatever the hype word of the moment might be?
So I think the key here, we like to keep things simple, but give you the choice of control to meet your own goals. And so the starting place really is owning the equity market broadly low cost. And so that means what's called market cap weighted index. So an index that just represents the 100 largest companies or the 20 largest companies in New Zealand. That's the market. And as soon as you start to deviate from that, you're making some form of decision. And it may be because you really believe that actually this theme or this sector is going to perform better than the market generally over the next decade or more. That's a great thing to do. And you can make those strategic choices. But in the very first instance, you want to just start with good diversification of the market. And so things like the NZ20 and Global 100, that gives you in 2 funds really simple exposure to what the world equity markets look like. From there, you can make more strategic or informed decisions. Maybe you've got a real interest in real estate or property and you think actually it's going to bounce back more, whatever it may be, and you can introduce that. Or same with infrastructure or any other theme. Maybe you like healthcare and you're going and buying a healthcare themed fund, or you really want to go for growth. So you're just going for companies that don't pay dividends. You just want to go for high growth. Now, those are things that are perfectly rational investment strategies. But I would suggest that for most people, starting with just owning the market, and then when you want to take those strategic decisions, don't necessarily build your whole portfolio around that. Go and put an allocation towards that. Say, actually, I really think healthcare is going to be the thing of the future. It's going to perform really well, and so I'm going to put 10% into that, or vice versa. It's a technology or whatever it may be. So take time to figure out what it is, and then make sure though that you are well diversified across the markets with just some simple, low-cost, diversified funds, and that's a great starting point, and that should form your foundation or your base, and you can't go too wrong from there. If you've got 10 years on your side and you own the market, you're going to do well. And if you look back on history, that's the best starting place.
Yeah. Yeah, absolutely. So I think, I suppose one of the other questions then, if people are now at the nitty-gritty stage of thinking, okay, I'm going to pick some core funds, I have, let's say, a little bit of interest in one or two different sectors that I also want to have a look at. Have you got some things that we should think about in terms of specifically researching when it comes to those funds? So if I'm doing my DD on my own portfolio, which I should be before making an investment choice, what am I looking for?
Yeah, so obviously it depends on what your approach is to what your strategy may be. So you may be starting at a very high level and just saying, actually, yeah, I really like what's going to happen globally. I think, with aging populations, healthcare as a sector at a high level is going to be performing better than energy or other sectors. And so that's the starting point for the strategy. When you're looking at funds, then it's around the real simple things, looking at what the fees are, what's investing in, how you're accessing that fund, how does it align with your other goals, and hopefully most funds out there will be really transparent, and you should, particularly index funds will be. And so you can go and see exactly what it's investing in. You want to make sure as well, you don't want to over-engineer your portfolio. We touched on that at our last webinar. We have seen cases where people have gone and bought 30 or 40 different index funds. Well, that's quite complicated. It's probably not doing much. You've probably got a lot of double ups. So the nice thing with index funds, you can actually really quickly go in there and look at what is the index fund investing in. Have I already got a lot of exposure to those companies, right? Yeah.
And I think on that, like one thing that people often miss or can be easily missed is that if you can't find the information through the fund, all index funds track an index, and all the major index providers have their own website. So S&P Dow Jones, who do our indices, they have the SP Global website. You can look up every single index that they offer on that site, and it gives you really great insights into historical performance of that index. What are the country exposures? What are the sector exposures? How does it work? Is it a market cap weighted index? Is it a different kind of index? And I think that's probably a really good starting point, because a fund is just meant to deliver on that.
Yeah, and so when you're starting to then put that together, and I think for us there's a lot that we want to do to help you guys make this even easier going forward. But when you think about, okay, I'm investing in the Global 100 and NZ20, you can think about how much exposure to each country you've got and the different companies. I would say the S&P website is a great place just to start and go and think about what information you want to learn from. So next to our fund holdings, so you can go on any fund page, you can see the full list of all the companies that each fund is invested in. You can see that with a couple of our funds, there are a couple of companies that double up. So there's some companies in the Dividend Aristocrats fund that are also in the Global 100. But it's relatively small, so that you can understand then actually if I invested in those two funds, I am getting some diversification benefits. They are in different sectors. So a good place to start by looking at that is next to our fund holdings is a link to the S&P webpage, and go in there and you'll be able to see all the countries that each fund's exposed to, the types of companies and sectors, and that gives you some really good information to think about what you're investing in. Because if you think about, for example, what we see probably a really common one is people buy a total world fund, but then they'll go and buy like a US 500 fund. Well, actually the total world funds often may have 30, 40% already exposed to the US equity market. So by buying a US 500 fund in addition to that, if that's your strategic choice, that's great, but just be conscious that obviously you're really exposed then to the US rather than broader equities.
Yeah.
So those are the things to think about when you're starting to add in more funds and more layers of information.
Yeah. And I think that that's probably a really good point just to touch on again, like why we designed our funds the way we did. So, as Dean has mentioned, the NZ20 and the Global 100 really are those core, broad-based, market diversified funds. The rest of them could, typically be classified as either sector funds or theme funds. And we have been very purposeful in, I suppose, releasing funds to market that can be complementary. So we're not in the game of, putting out a whole heap of different funds to confuse you guys or make it harder. They are designed so that you can pick or choose what suits you. So if you want to keep it simple, that might just be choosing between the two core funds, which is, NZ20 and Global 100 for your New Zealand global split. Or you could have a look at, basically factoring in other sectors and parts of the market. And we will continue to expand on that throughout the next year with the idea that you can add in different parts that will be complementary to what you already have.
So yeah, that's the key. Don't over-engineer it. Have some time to think about it. Start with a couple of funds, keep it simple and build from there. In terms of the fixed income piece, we don't offer any fixed income. You may want some exposure to that, but another thing to think about is actually, as Kat touched on, short-term cash needs, stuff that you need in the next couple of years. Maybe rather than having some fixed income within your portfolio, just go and put some into term deposits and some emergency savings. Reality is it's not going to make you much money, but at least you'll get something on the dollar and it's going to be there when you need it. And then the rest of your money can be invested so that it's maximized to help you reach your long-term goals.
Yeah, I would say, I'm sure everyone is tempted now and again to go and invest their emergency fund when they see that their emergency fund is getting nigh on anything. But, unfortunately, that's the price of comfort and the reason why we have it in cash. So, always resist that temptation and focus on your long-term investments being just that, for the long term. So, thanks for watching today, guys. Obviously, we dived into a few different nitty-gritty topics here. There's heaps more to think about when it comes to designing a portfolio and touching on different ages and stages. So please continue to send through your questions. We'll continue to roll these out over the next couple of months, and we will talk to you soon.
Thanks.
Thanks.